Hello, this is Ed Mofrat, Certified Public Accountant, President of Mofrat Financial Solutions. In this session, I'm going to discuss registered domestic partnership issues as they relate to preparation, amendment, and filing of tax returns. I'm also going to touch upon adoption credit issues as they relate to registered domestic partners. First of all, let's define registered domestic partnerships, or RDP. It's a legal relationship that's available for same-sex couples and for certain opposite-sex couples. If you are of opposite sex, at least one of the two individuals has to be over the age of 62 years old. Who can register as registered domestic partners? Both persons in the what we call community, which is another name for registered domestic partnership, must have a common residence. They must agree to be responsible for each other's basic living expenses. Neither can be married or a member of another domestic partnership. You cannot be related to each other. You must be at least 18 years old, both of you. And as we said before, must either be members of the same sex or at least one over the age of 62 if you're of opposite sex. So in other words, you can't be a couple of youngsters, a guy and a girl who just live together unmarried, and file registered domestic partnership. It's basically by and large designed for people of the same sex. Domicile. You must have the same domicile if you are going to register as domestic partners. What is a domicile? It is your permanent legal home. You must have only one domicile for both of you, even if you have more than one home. What determines your domicile? It's where you pay your state income taxes, where you vote, location of property you own, your citizenship, your length of residence, and business and social ties to the community. All those factors have to be considered in determining which of your homes is your domicile if you're fortunate enough to have more than one home. Now, this is only for California RDPs. Be alert. State community property laws mandate that you file married filing joint or married filing separate for the state and single for federal. What does that mean? That means that if you are registered as domestic partners in California, filing as single or head of household is not an option for the state. You must file married filing joint or married filing separate. For the federal, however, you have to file single, but it does not mean the same old way you used to do single, just considering you. You need to take your income and your partner's what's considered community income, add them, average them, and split them, and only report half of that total as your income. For your community income, deductions, credits, and withholdings, report all of the combined amounts on your joint state return and half of the combined amounts on your federal return. Whole exemptions have to be taken. In other words, if, let's say, between the two of you, you have three dependents, 3 children, or 3 dependents at any rate, you cannot each take 1.5 exemptions. You cannot average those. It has to be whole. The same way that if you split family, you cannot cut a kid in half. You have to take a whole kid with one parent or the other. Same goes with the exemptions for your dependents. It has to be whole exemptions per dependent per agreement. RDPs may file amended returns for prior years for federal and or state, but are not required to do so. This generally provides a lot of flexibility for RDPs because they can consider their last generally 3 years within the statute of limitation for amendments for both federal and state, and consider if they would have saved money or taxation if they had filed joint, and only if they decide it's to their benefit, to their advantage, they can amend. They don't have to, it's an option. Okay, the next thing you need to consider, there are two types of properties and income, community or separate. You need to determine of all the incomes between the two of you, which ones are community and which ones are separate. You, your spouse, in this case spouse means your partner or a registered domestic partner, or both, for a property to be considered community, you must acquire it during your RDP or same-sex marriage period. Or you and your spouse must agree to convert it from separate property to community property. And any property that cannot be identified as separate is also community property. Community income is income from community property, and also salaries, wages, and business income of you and your spouse during the RDP or same-sex marriage. So in general, wages, business income, interest, dividends, community property rental income are considered community income and community property. However, if you cash in an old IRA, or if you receive Social Security benefits, or if you get some pension from an old fund, anything that pertains to you, independent of your community union, is considered separate property. So in more formal terms, a separate property is that which you or your spouse own separately before your RDP or same-sex marriage period. It's money that you earned while domiciled in a non-community property state. It's property either of you received as a gift or inheritance separately, or property bought with separate funds, or property you and your spouse agreed to convert from community to separate property. And separate income, of course, is income from separate property. Income belongs to the spouse who owns the property. For instance, if the father of one of the two partners wills a rental property to his son or daughter, that property does not have to enter into the community. It can remain a separate property for the partner that it was intended for. The partner can choose to make it part of the community property, but that's a choice that that partner needs to make. For a registered domestic partner, when it comes to paying estimated tax payments, you must pay it separately. You cannot pay joint with your partner. You have to pay separately. So you need to determine whether you must pay estimated tax payments in the first place by taking into account half of the community income that you get from being in a community with your partner and the deductions, and all of your separate income and deductions, and then your own exemptions and any exemptions for dependents that you can claim. After you take all of that into the picture, then if you decide that you need to pay estimated taxes, you need to pay it on a check from you under your own name. And once you make the estimated tax payments, you get credit for only the estimated taxes that you paid, not for your partners. So in this respect, everything is still separate for estimated tax payments. Okay, next let's talk about child adoption credit. If a same-sex couple adopts a child together, one or both of the partners qualify for the adoption credit. Each partner can claim the amount of the qualified adoption expenses that he or she paid or incurred for the adoption, but the adoption credit is limited to $13,360 per child. So the partners may allocate this maximum between them, but the allocated amount may not be more than the amount of the expenses he or she paid or incurred. So if partner A pays, let's say, $4,000, partner B pays $5,000, each can claim their entire credit, which adds up to $9,000. But if one, let's say, had $5,000, the other one had $10,000, and it added up to more than $13,360, then they need to agree how to apportion it so that the maximum that they deduct is $13,360. If a taxpayer adopts the child of his or her same-sex partner as a second parent or co-parent, the taxpayer, which is the adopting parent, may claim the adoption credit. The law does not allow, here's the interesting part, the law does not allow taxpayers to claim an adoption credit for expenses incurred in adopting the child of the taxpayer's spouse. However, this limitation does not apply to adoptions by same-sex partners because they are not treated as spouses under federal law. So here it actually works to the advantage of the registered domestic partners not to be considered spouses. So the next question that comes up is the same-sex partner the step-parent of his or her partner's child? And the answer is, it depends on the state. If a same-sex partner is the step-parent of his or her partner's child under the laws of the state in which the partners reside, then the same-sex partner is the step-parent of the child for federal income tax purposes. Then we come to some good news. The big hurdle that stands in the way of gay marriage is the acronym DOMA, D-O-M-A, which stands for Defense of Marriage Act. And it's defined as marriage being only legal between one man and one woman. But here is the good news. The DOMA is being challenged in this Supreme Court of the United States, and the Supreme Court is expected to rule on this issue sometime this year, presumably March of 2013. And the results will become public most likely in June of 2013. If DOMA is found unconstitutional, same-sex married couples and RDPs will be able to file joint federal returns for the first time in the history of the United States, and will be able to amend prior returns to claim married status based on the statute of limitation laws, which generally allows any individual or couple to go back for 3 years and amend their returns. So everybody is waiting to hear what the Supreme Court will decide in this regard. All right, here are some useful items to consider. You may want to look this up on your own. We're going to give you some publications that the IRS and Franchise Tax Board put out to help the public with these issues. One is PUB, as is commonly known, PUB 504, which deals with divorce or separated individuals issues. The next is PUB 505, which is a tax withholding and estimated tax publication that the IRS releases. The next one is Publication 971, which stands for Innocent Spouse Relief Topics. Franchise Tax Board issues Publication 776, which deals with tax information for same-sex married couples, and in California they are called married couples. There is a form that we want to tell you about. It's Form 8857. It says Request for Innocent Spouse Relief. So if you are in a relationship and you do want to stay separate from each other's finances, furthermore, you want to go one step further and declare that you have nothing to do with the financial wheelings and dealings of your spouse, you fill out this Form 8857 and you attach it to your return. And this tells the taxing authorities that you really are independent of your partner's taxes and other financial situations. The next, we want to give you some useful contact information. For comments and suggestions, you can contact the IRS at the address that is presented here. It's the Branch of Individual and Specialty Forms and Publications branch. You can see the address, the email, and the phone number you can call for tax questions. And also, if you want to order forms and publications, you can contact the information on the right side of the page that is before you right now. You can call us with your questions and answers, or contact us, email us at our office. Thank you for watching and listening. Remember that we are here to serve you. Registered domestic partnership is our expertise, but our motto is, if it is taxes, we do it. So please feel free to reach out at any time.